On a relative basis right now, if you look at the Bitcoin gold chart, Bitcoin is a screaming buy in gold terms. And therefore, my sense is that gold goes higher. I mean, I put it at 5 or 6,000, maybe the end of next year. And I don't think a $10,000 or $20,000 target is out of the question. If the stock market, to me, looks like an accident waiting to happen.
Lepard is clear and consistent in his framing. Bitcoin is digital gold, but expecting it to instantly replace gold misunderstands both markets and human psychology. For the average person, inflation protection still means gold and silver. Bitcoin remains misunderstood, mischaracterized, and often dismissed due to scams, meme coins, and speculative excess. Lepard recounts a simple but telling story. Someone at the gym dismissing Bitcoin because of Trump coin and other nonsense flooding the market. And in a sense, that person isn't wrong. Much of crypto is garbage, but Bitcoin is different. Bitcoin is not a company, a promoter, or a political project. It is an algorithm, a protocol, and a monetary network with a strictly limited supply. That distinction matters. Over time, Lepard believes Bitcoin will continue to grow in credibility and adoption precisely because it shares gold's most important trait, scarcity. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support. Let's continue.
Bitcoin, in my view, is digital gold. Digital gold will ultimately catch up with and surpass analog gold. But as I've always told all my Bitcoin friends, guys, this is a process and it takes years and decades. I mean, gold's got a 5,000-year head start. And the average person, when they think inflation protection, they think gold and silver. They don't think Bitcoin. They don't even know what it is. And like so many people, like the guy I was just at the gym with this morning, he said to me, well, yeah, I was going to buy it, but Trump coin came out and I think all that stuff's bullshit. And he's right. Trump coin is bullshit, but Bitcoin's not. Bitcoin's an algorithm, and it's a protocol that's going to, in my view, continue to grow. So on a relative basis right now, if you look at the Bitcoin gold chart, Bitcoin is a screaming buy in gold terms. And some people, the gold people say, well, therefore, and Peter Schiff and others say, yeah, in fact, it's a screaming buy because it's going to go to zero. And I just don't believe that. I think Bitcoin is going to be just fine. And it's so funny to me, Adam, because this kind of reminds me back in 2023 when Bitcoin was soaring and gold was doing poorly. Everyone thought, oh, this is new digital gold and silver are dead and they're never going to live. And those miners, they suck and blah, blah, blah. And Bitcoin was the bright, shiny thing, right? And right now, and nobody wanted any gold and silver, of course, and I hung in there managing my fund, believing they would ultimately work. And right now, gold and silver are bright, shiny things, and they're working great. And everybody who's in them is growing, and I get it. I'm in them too, and I'm happy that they're working. And Bitcoin's kind of a dog, and people are blaming Saylor and MicroStrategy, and to me, it's just a screaming opportunity. I mean, I look at MicroStrategy today. That stock's a 10-bagger in the next 5 years, in my view. And I'll be buying it, with silver and gold proceeds here next year. So,
well, that was a question I was going to get to. Are you shifting any gold into Bitcoin?
I am at the margin. Yeah, at the margin. I mean, I think I made it pretty clear what my weightings were. I think coming into this year, I was about 70% Bitcoin, 30% gold. Well, guess what happens when all the gold stuff doubles in value? Because that was gold stocks, and my fund is up 150% year to date, 148 through November, and I think we're up 10% this month. So, we're going to be up 150, 160% this year. And so,
congratulations.
Thank you. I mean, it's not that much better than the averages, by the way, which is a little frustrating to me, but full disclosure. But the point is that, you take that, you do that in 70-30 Bitcoin gold, you hold the Bitcoin flat, you double the value of the gold. Well, now I'm probably 60-40 gold Bitcoin. And, so I will be lightening up on some of those gold stocks, not selling them all, not dumping gold. But I mean, this is, to my way of seeing it, this is what a professional investor does. You try to buy what's cheap and out of favor, and you try to sell the things that are screaming. And, I think they're going to keep screaming, but I also think that on a relative basis, Bitcoin and MicroStrategy are probably better bets right here, even though they don't feel that way. And, your show talks about this a lot. I mean, sometimes in investing, what feels uncomfortable is what's right. And what feels comfortable and obvious actually turns out to be wrong. And right now, it might feel really comfortable and obvious to be in silver and gold mining stocks. And I think we've got another good year or so here for sure, but I don't think Bitcoin's dead, and I think it's relatively cheap. And keep in mind that the underlying theme of the book and of what you're talking about, what I'm talking about is, there's, call it $900 trillion of financial assets out there, gold, stock, bonds, everything, all including real estate. So actually there's 450 if you just do the financial, take the real estate out. Well, the total Bitcoin marketplace is 1.8 trillion and the total gold marketplace is 30, but really only about half that gold's available for sale because all the rest is either in jewelry or in a museum. Mm-hmm. And so it's really about a $15 trillion market. Bitcoin, call it a $2 trillion market. That's 17 out of 450. And that 450 is growing, and it's probably about to grow a lot more rapidly because the Fed just started the pivot, which is what is my friend Lynn calls the gradual print. She's right. It's gradual so far.
Gradual print.
But I think it's going to morph into the big print. And I wrote a book about it, obviously. And, because mathematically it has to. And so I think as it does morph into the big print, all these sound money alternatives, real estate, gold, silver, Bitcoin, they're all going to go higher. In fiat terms, the negative is, of course, be careful what you wish for, because so is the price of hamburger and so is the price of gasoline.
Lepard views the current environment as a secular bear market for fiat currencies and a secular bull market for real assets. Gold's recent rise is not speculative mania. It is a loss of faith in government-backed currencies. The freezing of foreign reserves, rising geopolitical tensions, and chronic deficit spending have accelerated that loss of trust. He projects gold reaching $5,000 to $6,000 in the near term and believes $10,000 to $20,000 is plausible in a full-cycle bull market. From a historical perspective, Lepard argues we are still in the early innings. Bitcoin, despite being digital and synthetic, belongs in the same category because its supply is mathematically constrained. It behaves like sound money, just expressed through code rather than metal.
Where do you see gold going in the coming year? Do you see it continuing to power higher or taking?
I definitely think it's going to power higher, and it has not been a parabolic move. It's been a strong move. And gold to me just reflects the loss of faith in fiat currencies and what happened post, our grabbing the Russian assets. And so, I sincerely believe we are in a, secular bear market for fiat and a secular bull market for real things, including gold, silver, real estate, Bitcoin. Well, Bitcoin's a synthetic thing, but it's real in terms of the algorithm being limiting its supply. And therefore, my sense is that gold goes higher. I mean, I put it at 5,000 or 6,000, maybe the end of next year. And I don't think a $10,000 or $20,000 target is out of the question. If you look at historical bull markets in gold, what they've done from the bottom to the top. I mean, if we call the bottom, you can call the bottom either, $1,000 back in 2015, or you can call it a more recent bottom, kind of the 2,000, 3,000 area. To my view, we're still in the second or third inning here. So I'm quite bullish on gold. It's interesting too. And then this is, tooting my own horn, Adam. I mean, I'm really bullish on the miners. I mean, the miners are up a lot this year, but not as much as they should be, given how much the metals have moved, particularly silver.
Yeah. What's the why behind that, do you think?
Well, I think it's a tough business. And the miners annihilated a generation of investors between 2011 and 2015, and I was one of them. It was damn awful. And as a result of that, there's I call it the battered gold bull syndrome, battered gold stock bull syndrome. And it was just so awful and so ugly, and the businesses are such a tough business that, in spite of the fact that the metal is going crazy and the margins are 60% plus, we're still looking at companies trading at 5 to 7x cash flow when, the big triple Q companies all trade at 50 times or 20 to 50 times cash flow. And, they're both making cash, and a business is a function of its future cash flows. And so, now some of those triple Q companies are monopolies, and so they're probably more defensible than some of the miners are, in the sense that, this is a commodity. But they really, in my view, we're still kind of in the third inning for the mining shares. And although my fund is up a lot this year, I think we'll have a pretty good year next year too. And I think one way, if you feel late to buying the actual metals and you're willing, to size it appropriately so you can handle the volatility, I still think just buying the mining ETFs is not a bad idea. For the first time in my life, I actually am kind of feeling like I want to actually hold a little bit of cash too. And I'll tell you why. I mean, one of the world's smartest investors, Warren Buffett, has built up a big, stash of cash. The stock market, to me, looks like an accident waiting to happen, but I'm not going to call the top because I've tried that for 10 years. I've been dead ass wrong. I've lost a lot of money, on put options. We live in a very uncertain world. And I do feel like there's some point, and the AI thing, look, it is changing the world. It's great technology. It's like the internet. It's going to change all our lives. Okay, fine. But it strikes me as being ahead of itself. I have a real, you were around it. I know you were at Yahoo in the early days in 2008. Or 2000.
Not early enough, but early.
Yeah, right. I have a real deja vu with the .com bubble here and AI. And so, cash is very valuable. In 1929, cash was really valuable because the price of everything was about to fall 90%. And so, you could then come in in 1931 or 32 and scoop up, good quality companies at 10% of their prior value.
The Rothschild, blood in the streets. Yeah,
exactly. And so, with that, and by the way, I think that's one of the greatest risks to all investors. I think all investors are kind of sleepwalking into this, that to get my big print, we probably need something to break. We've had two big prints already, and I'm predicting a third one. The first big one was 2008. The second big one was COVID. And in both cases, there was a trigger, right? In 2008, it was the housing bubble. And in COVID, it was COVID, right? And so, it's possible that we're going to need, for the truly big print that I foresee, where the Fed grows its balance sheet, not, this 30 to 50,000, 40 billion a month, but I'm talking, trillions, right?
Right. You're going to need some systemic pain before that gets
systemic pain, something breaking big, something failing, problems, etc. Kind of a panic. And when you get those, guess what? Everything goes down in fiat terms, just by definition, because everyone's so levered, and everyone scrambles for cash. And when they do, cash becomes king. And so, and of course, we know the reason I wrote the book, the reason I believe that condition probably won't last very long, is that we've seen their playbook, and we know that their third mandate is financial stability.
Lawrence Lepard's message is not one of fear. It is one of preparation. We are witnessing the slow unraveling of a fiat-based monetary system that has reached its mathematical limits. The response, as history shows, will be more money creation, more distortion, and more volatility. In that world, sound money wins. Gold, silver, real estate, and Bitcoin are not speculative trades. They are monetary lifeboats. Bitcoin may feel uncomfortable today. It may feel boring, controversial, or out of favor. But history suggests that discomfort is often the price of future returns. Bitcoin is not dead, gold is not obsolete, and fiat currency, while still dominant, is on borrowed time. As Lepard makes clear, the real risk is not volatility. It is complacency.